Good morning, good afternoon, good evening, and welcome to the TGI Friday. The Thank God It's Friday, the 16th of December, Bull versus Bear webinar. Steve Miley on the call for TradeDay.com. Welcome, everyone. We'll go through our usual regular run through in here today, calendar, what we've had, what we've got coming up, macro fundamental events as covered by the news wires, what's going on in markets right now, what's influencing markets, and then we'll take a look at the charts. Where are the potential trigger points for today from my perspective? Okay, let's take a look first of all at data. So obviously, last 24 hours, again, markets have been super volatile. Obviously, Tuesday, CPI, Fed, Wednesday, yesterday, retail sales, plus the Bank of England, plus the ECB. ECB more hawkish than anticipated. Saw a significant sell-off in European bond markets yesterday. Bond markets lower in price, higher in yields. So a definite more hawkish shift there. Definitely some kind of feeling of a slightly more hawkish tone coming through from the Fed and from the Bank of England to a lesser extent. And then the core retail and then the retail sales yesterday, if we go back to yesterday's data from the US, where are we? So here we go. Retail sales data in here, missing expectations, looking for plus 0.2, came in at minus 0.2, disappointing the market. Real concerns now of recession for the US next year, also for Europe and for UK. And obviously the central banks, if anything, are telling us they're more on the hawkish side. So you kind of got double bubble, double trouble with respect to both the data's telling us, yes, we're slowing down. Yes, the central banks are more hawkish. We've been checking the Fed tool, right? Remember the Fed tool in here telling us that, we're looking at the peak in here from the Fed tool in here going out to the middle of next year. Why is that not updated? Oh, here we go. Oh, no. I think that's sticking. Is that moving? No, it's not moving. Why is that not updating? Strange. Looks like it's a glitch on the Fed tool from the CME. 1 second. Let me see if it reloads. All right, there's definitely some kind of glitch in here because it's not even real. Oh, here we go. Let me see. No, there's a glitch on here. It's not updating. But as we looked at previously, the peak in here they're showing is way below the peak that the Fed are telling us. The Fed are telling us 5.1. Oh, here we go. So it's very delayed. The Fed are telling us 5.1. So we are actually seeing now a push up, into June now, 475 to 500 peak. So this has actually started to shift higher now. We are seeing this to start to shift higher. The peak in rates now 475 to 500 in here. But the Fed are telling us 5.1. But if we go out to December, God, there's something definitely wrong with this. It's very slow to react. It's not moving along the tabs. But we're showing a rate cut for next year. So, issues on the Fed tool in here. But, yeah, the market's still pricing in a kind of a less aggressive Fed, and then them looking for them to become more dovish going into the second part of next year. And that's not what the Fed are telling us. ECB, as I said, were more hawkish. You could argue that here we go. It's very, very slow. So looking for cuts in here by the end of next year. So ECB more hawkish, Bank of England to an extent slightly more hawkish. And the data now starting to come through to tell us, as we show here from yesterday, the economy is slowing and real concern about that. Market is triple/quadruple. Oh no, single stock option. So triple witching, quadruple witching, whatever it is these days. You know what? That used to be a really big thing some time ago. I haven't seen it really impacting on markets. The expiry. Futures and options expiries, I've not really seen it significantly impact. I mean, it can do. You can get little pockets of volatility, but I haven't really seen it massively impact on markets. But do make sure you're not trading deck anymore on the indices. But I haven't really seen it as been a really big deal. Sometimes you say you get these little spiky moves as people are covering, or if you break kind of significant levels, particularly if you're around some of the round numbers, some of the strike zones, you can get a little bit of extra volatility. But I haven't really seen it been a significant impact on markets of late, or actually for some time now. It doesn't really seem to have a significantly big impact. Right. Yeah, it's a little bit more volatile the week before, but this week's obviously we've had so many big events this week. It's been clouded anyway by the big events. So recession fears concerned around the globe. France shows faces a greater recession with PMI data. Oh yeah, we've got PMI data. Let's go back to today. Sorry, I didn't finish off. Got sidetracked all over there. Data for today though. So look, retail sales data. We spoke about today's US retail sales data. UK retail sales data. Look, a sea of red. Okay, missing expectations in here. Worse than expectations. So retail sales data slowing down more than expected. PMI data you can see in here. Service sector and global data. Composite data from France, missing expectations. German data actually beat expectations, you can see in there. Eurozone data actually beat expectations. UK was mixed. Composite, the manufacturing worse than, the service UK better than. CPI data in here for the Eurozone, actually better than expected. So I know it's red, but remember it says worse than expected there. Look, it actually pops up. But it's better because it's lower than expected. And here, obviously, lower inflation data is better than expected. And looking forward into this afternoon, we get the S&P Global flash PMI. Remember, this is flash PMI data. This is not from the ISM. This is the data from S&P Global that bought market IHS previously. So, that data there is less important in some ways, this data, than the ISM data for the US, but we do get it for global. Remember, the ISM is a US institution. So we get the global data. So we've had all this global data. And this is the flash PMI. This is the heads up data for this month, for December. So it's very, very, very current data. And you know what? They take this from a survey of about 80, 90%. I think the flash PMI data is from the full data group. So that's a pretty strong indication anyway. So this is very close to what the final PMI data is. And we're obviously getting it now today on the 16th of December. Normally it comes out in the 20 something, but I think because of Christmas it's been released early, so we're getting this early, halfway through the month. I'm assuming they're still doing it with the survey being of something like 80% of the those being surveyed. So this is important set of data. It's not quite seen as important when we get the final data as the ISM data in the US, but nevertheless it's a good heads up we're getting there. So we're definitely going to be watching that this afternoon. It's 09:45 a.m. New York Eastern time. Okay, so certainly keep an eye on that. That's what we've got coming up. But we're kind of at a mixed bag from that data from this morning. French data missing, mixed on the UK, and German data beating, and the Eurozone as a whole data beating. Retail sales at the UK. So all of this so far this morning has been slightly negative. European stocks have suffered. Obviously, we were already down yesterday with the retail sales data, with the aftermath of the Fed. All the kind of the more, as I've said right at the beginning in here, the central banks are all indicating more hawkish. We had a big sell-off in bonds in here. I can show you what's going on here. Investing.com, temporarily down. Oh no, it's back up again. Let me go and show you the world. If I go and show you the bond market in here, and I can probably show you in here. If I go to my trading view charts in here, I'll go to this is my trading view, and then if I go and show you the bonds, this is the German government bond. Okay, this is the chart I put out for some of my institutional clients. So you can see in here, this is a daily chart. So yesterday, boom, massive sell-off, and again, boom, down today. Okay, so big sell-offs in German government bonds, or German/European government bonds in here. The futures market, this is the equivalent of the 10-year future in the US, 10-year note. Okay, so big sell-off the last 2 days. That's lower in bond prices, higher in bond yields. That is primarily on the back of the ECB, but also being driven lower today by that negative data that we've seen in here from the flash PMI data in here. And if I go back into here, we can see that in yield terms. So if I go in and take a look at German government bond, and I'll just go to the 10-year in here, just do 10-year. Hopefully this will work. Sometimes it's a bit fickle. Okay, there we go. It's actually worked quite well. If I just go and show you the German 10-year bond, I pop out a technical chart. And, there you go. Look, so there's the yield move in here. And probably better if I put it on a candlestick. There you go. The last 2 days. Boom, boom. Okay. A big spike in yields. We were sitting like 190 in yields. And now we're up at like hit 220. So up 30 basis points in yield. It's a significant move for German government bond yields. Okay. So we've seen that in here. Okay. So what else do we have? So recessionary fears. This is where that came from. In here, so the PMI data, UK companies. We'd already mentioned that in here. So all negatives coming through from Europe this morning. Watch out for volatility here. There you go. They're mentioning the witching in here. As you've mentioned there, quarterly triple witching. Okay, stock index, futures, equity index options, and stock options all expire. Potential to crack down on TikTok from US senators call for, not really impacting us. Equity sell-off deepens. This is really a follow-through from Europe, though, this morning. And so it's not just all happening in the US. A lot of this is being driven out of Europe in here this morning. And then coming up, we've got the PMI data, which we have mentioned. Speech on the economy daily. So daily is speaking. Didn't pick that up on the calendar. Maybe I missed that. Maybe it's not on there. Can we see daily? No, I can't see daily. So daily is speaking later today. So watching out for that as well. So what's happening overnight? Well, equity sell-off deepens, recession fears, central bank have warned of more campaign, hiking rates. We've already covered that. Dollar swings between gains and losses. Treasuries decline. Treasuries have gone low now. Treasuries were popping higher in here. I've set us up on but if we looked, treasuries were fairly resilient yesterday. Okay, look, so we're fairly resilient, but back lower in here, getting probably dragged down in here. So treasuries have been bought because of recessionary fears, okay? But then what we're seeing is a dip lower. That's probably being pulled down by European bonds going lower in here, no doubt, this morning. So treasuries lower this morning. So, yeah, futures equity market sell-off. Reuters covering that as well. Stock bonds stung by hawkish central banks. And then futures extend losses on recession fears. Oil's parried gains. So oil has been fairly positive in here, but oil has fallen this morning on the back of, just this general risk-off phase that we're in right now. Global recession risks rise as central banks raise rates. We've already mentioned all that. Fed, EC, BOE, not only raising rates, but also spelling out a more hawkish tone. However, most banks see more ECB rate hikes with potentially a higher peak. And then if we look at European bourses this morning, we're pretty much over 1% down, 1.25% down on the FTSE and the UK FTSE and the French CAC, and 0.8 down on the German DAX. And if we look at the futures for this morning, we're down over 1% across the board. Nasdaq's actually only down 0.75%, but the S&P over 1% down this morning. Let's take a look at some of the charts. So we've already looked at treasuries, and they are looking a little bit wobbly this morning. So you've had multiple failures now. If you look on treasuries, I've been hanging on to a bullish tone. I'll start with the treasuries and the commodities. So you've had this kind of underlying bullish tone, the underlying uptrend. We have kind of been flirting with this trend line. The market then pushing up again. So 3 times it's pushed up into this area and failed back lower. And you can see yesterday pushing up again, failing at the peak there. From earlier this week, the peak was at 132.13. Yesterday got 132.15 and failed, and now back lower this morning. So a slight shift, I would say, potentially for a more negative tone. You've got setting up for a double top pattern up there, okay? And real risk, I think, now for treasuries to go lower going into today. So you've got support in here on the downside as an initial target, 130.25, and then that spike low down there at 130.10. Easily see those being hit today. And then if we break 130.10, then you've got double top pattern, and we could be tracing down here to the mid 129s. Okay, so treasuries looking more negative. While we're there, let's take a look at gold and bonds, gold and oil. Gold down lower in here. Remember, there is a positive correlation with risk in here with gold at the moment. Usually, obviously, gold is seen as a safe haven, but at the moment it's trading with stocks. Okay, so the sell-off yesterday impacting on gold. We have taken out some important supports in here on gold. And if we look in here, wiped out these supports, you've got, again, a potential topping pattern. 1, 2, 3, 4, 5, 6, 6 peaks all in this area here. You've only got that spike. Really, they're all in this area here, are all of these peaks. And then you just got the spike above there. So the market's multiple failures here. We've taken out that low and then sitting not far above that low. Through there is like a multiple top in here. So that low there, is 1778.1. We've been chopping in here since overnight, okay, but it's looking fairly negative. Whilst below that little peak there, 1796.2. Only back above there offers the bulls some upside. Otherwise, I think all the risk is down for a challenge to that low. And if we break this low, it could easily be down towards here, down towards 1760. Okay, down through that low there, 1778.1. Even a break below these current lows, you've got a string of lows in here between 1784 and 1782. Down through there, it looks a lot more negative for gold. Let's take a look at oil. Again, oil's been fairly positive in here. However, an indecisive but negative day yesterday, and then taking out support this morning. And if we go down in here on the 15-minute chart, you can see now we've reversed the uptrend line clearly easily through this uptrend line that comes up like through here. Okay, so that's reversed now. You then got topping pattern, double top, confirmed through there. We've already hit the measure of that little double top. So the double top measure is only from there to there. So you've already hit that, okay? But then you've also taken out now that low. Now you've got a succession of lower lows and lower highs. And look, going south again. Minimal targets down here towards 73.20, 72.80 kind of area. That will be minimal target. Risk for a deeper move down towards 70.50, 70.00. So oil looking negative. So it's all looking very risk off, all looking fairly negative in here this morning. S&P wiped out these supports we'd flagged here yesterday, and then no real rebound, and then lower again in here this morning. You can see there's a bit of a vacuum now down towards here, okay? I would probably be looking at the Fibonacci retracement. So let's make this a little bit bigger of the whole move. Okay, peak to trough from October through this week. Okay, and there you've got the halfway point is at like 38.54. Down through there, then does open risk. Then you've got the 61.8, and then these impulse lows. Remember, that was the last set of CPI data. You got this big shooting star on the CPI data at the top. You had a big kind of like sort of like a hammer at the bottom. You got the big impulsive one in the middle. So kind of the tail of the tape has all been about the CPI here, and now here at the top. And then the risk is back to the halfway point. Okay, so minimally there. And then I don't think we're going to be all the way down here today, but there is a threat, down into here. I don't think we're going down to there, but I think we could easily see a move down towards 38.55, 54 kind of area. Maybe then looking to catch the rebound there. And then in here, just zooming in on the 15-minute chart on that, you can see now definitely succession of lower lows in here. The market did breach this downtrend line and then quickly lower again. Again, it's flirting with the same trend line. We're probably redrawing this trend line in here now. So if I can just, and I'd probably pull it down off of that peak as well. Whoops. I'd probably bring it into here. It always does this. It's not very friendly to get it to move around. There we go. Okay. Yeah, so minimally, I think you need to be back up, all the way back up through. You've got this little breakdown point here from the overnight as well, from yesterday's low, and then the trend line. So minimally, S&P needs 39.067 kind of stuff to start to ease the bearish pressures. Ultimately, it needs to be back above there, 39.40. 39.39, it's to be more negative. Otherwise, I can only see it going south. Same levels, same outlook, very negative on NASDAQ. Lower this morning, have had a slight bounce on NASDAQ, not quite as damaged on the NASDAQ. And probably NASDAQ being helped by the fact that bonds are going slightly to lower yields more recently. But nevertheless, what does the NASDAQ need to do? Well, this trend line's pretty good. It's been flirting with it. It's flirted with it again. Probably want to redraw that, if it will allow me, like down through like there, and it's flirting with it again. So NASDAQ's offering you a little bit more. I think you need to, if you're trading the S&P, keep an eye on the NASDAQ in here. I'm sure you do anyway, guys. But if the NASDAQ can get just above here, back above like I would say even like the breakdown point here, if the Nasdaq gets back above 11,400, it starts to look slightly more positive. If it can get to 475 and then certainly to 11,500, then the Nasdaq looks more positive and it could pull the S&P back up with it. Yeah, so Nasdaq less negative for a change, which doesn't usually happen. Looking less negative than the S&P in here at the moment. So this could be. I think you need, if you're trading the S&P, if we look at it here on the 15-minute, looks a lot more negative here than the Nasdaq. The Nasdaq looks like it's trying to build a bit of a base. So watching out for the Nasdaq to take the leadership potentially on the way back up. I am bearish going into this, but I think you have to be really flexible in the market. We've had obviously a big down couple of days in here, and there is a risk of some short covering going into the weekend. So watching out for that as well. You've got the, as Mark's pointed out, we've got the triple witching. We've got lots of stuff going on in here at the moment, and we've got that data a little later as well, the PMI data, flash PMI. So I'm watching all of that, guys. Helmets and goggles on for the end of the week, TGI Friday and all that. Have a great weekend. I'll be back with you with another bull versus bear webinar on Monday. We will be doing a technical Tuesday on Tuesday. Watch out in the feeds for when that is going to be. So there will be technical Tuesday coming up next week on the, 16, 17, 18, 19, the 20th. Okay, that'll be the last one for the year. And then I will post on there what time that is going to be on Tuesday. But until then, until next week, have a great trading week. Stay safe and take care. And have a good one.